afternoon, everyone. And it's a pleasure to welcome you to this exciting panel. Well, I wish we could have more people in the room to sort of witness the conversation with us. But yeah, so we're going to be talking about innovations shaping Africa's capital markets. For the next 40 to 45 minutes, you're going to hear from this wonderful panel. Hear them talking about pressing and transformative trends that they are seeing in the African capital market space that are shaping investing in Africa. We're going to talk on alternative debt strategies. We're going to talk about capital market innovations up onto cross-border trade flows that we are seeing moving capital in the continent. And from my role as an investment manager at Signal Capital, where we manage the African Local Currency Bond Fund, I have seen improving trends, and Africa make really giant strides in recent times relating to capital market development. As a bond investor, I've seen diversity in the number of issuers where capital market now is no longer the domain of just sovereign issuers and banks. We are seeing SMEs and mid-sized corporates come to the capital market to issue bonds. We've also seen variety in the types of instruments that are being used, from structured notes to labeled green bonds and social bonds as well. All of this we're going to cover on this panel. And I have with me a group of experts which bring their own unique and practical views to the conversation we're going to be having today. Allow me to introduce our panel. I have Marianne Vidal, who is a Director of Ecosystems at IMP, where she's responsible for ecosystem development, and she recently co-authored a publication on how SME funds can better mobilize capital in Africa. I also have Jumai Mohammed, who is a director at BII. She is an impact investor. She's also a strong advocate for capital market development and also inclusive financing. Then Sharif Abdullah. Sharif is an executive director at Camco Invest. He has over $25 billion worth of transactions under his belt. And he has a lot of expertise in cross-regional transactions, structuring, and exit, which we'll hear from him as we go along on the panel. And finally, the last but not the least, allow me to introduce to you Inde Chow, okay, who is a managing partner at Brightmore Capital. She is a West African Francophone-focused impact investor as well, mostly investing in SMEs with high growth potential and also with deep regional networks. So these are my panel. Please welcome the panelists. Thank you. So let's get into it. I want to start by asking all of you to sort of share your views on, I want to hear from you very briefly on what you find to be the most disruptive shifts that are sort of shaping the African capital market, and how you sort of see that either influencing investor behavior or helping you to further mobilize and deploy capital on the continent. Marianne, if you want to go.
Yeah, okay. Thank you, Fola, and very nice to be here with all of you guys. I mean, we're living interesting times in terms of SME investing. We've seen many different things arriving in the last few years. A lot of emerging fund managers, a lot of African and Africa-based teams. The report that Fola was talking about is the analysis of a sample of 135 funds that were created in the last 10 years, and 71% of them are African or Africa-based team, and that's really something new. A lot of different asset classes, a lot of different strategies, and overall the same goal to overcome the fundraising issues that we will be talking about. So yeah, I guess I would put the emphasis on all those strategies in terms of structuring, in terms of performance and team recruitment that we will be talking about.
Definitely.
Okay. Thank you. Maybe just a very quick introduction of BI. BI is the British International Investment. It is the UK development finance institution. It's been investing on the African continent north of 75 years. And we've done so several ways, through funds investment, equity, debt investment, and we wear a dual hat where we have to think commercial returns as well as impact. And I think it's important to give that context as we just get through some of the discussions today. I think when you ask what innovation is, I'm seeing that is shaping the capital markets, I think we've seen quite a lot over the years, but I'm very excited to see more mobilization, blended capital type structures. Scale is a massive challenge we've seen in the SME space, and just generally for businesses in Africa, we're starting to see pooled structures. De-risking is another key one. Risk sharing, I'm really excited to talk more about as we get through the discussion.
Thanks so much. Sheriff?
To clarify this point, again, as my colleagues mentioned, it's Hi. Yes. To clarify this point, I think as my colleagues mentioned, it's a bit deep one. However, still the African markets lag a lot of required sophistication, efficiency, and maturity. So this will come, I think, throughout the discussions over the panel. However, again, this creates a very good opportunity for the future for the continent and the African continent and exchanges, because there is a massive growth way to go. So we suffer from like the currency fluctuations over what is mentioned, and again, let's talk into more details later in the session.
I think for me, one of the most disruptive things that has happened is the fact that because of development aid that has been dwindled in the past few months, that has reshaped how money is being raised for us, and that has put in place more focus on private debt, for example, which was not heard of, but not for smaller ticket size, but it's becoming more of something that is upcoming. It's forecasted that it's about 20% of private transactions now, whereas before we were talking less than 15%. So that's one of the things. The other thing that is coming because of this change is also local resource mobilization. So we hear more and more pension funds, local insurance companies that are stepping up and providing more resources than we had before. So things are being reshaped in that and bringing in different types of investors.
Thanks to all of you. So you've sort of painted a really good landscape for us to have this conversation on. I'm hearing, some challenges. I'm also hearing quite a number of innovative solutions. Jumai, you've talked about de-risking. Marianne, you've also touched on fund structuring. Sharif as well. Then you've also mentioned local mobilization of capital on the ground, which are all interesting. And perhaps maybe we take a little bit of a step back to talk about those challenges that those solutions were created to solve for. So Marianne, in your publication, you mentioned that 45% of SME funds did not attain their first close, right? It would be good to hear from you. Why is it still so challenging to mobilize capital for SME funds in Africa? And what do you think, or rather, what are the effective structures that you're seeing that are working and are proven to be quite, scalable on the continent?
Yeah, so in terms of fundraising, to be clear on the sample that we've analyzed, 45% indeed did not reach first close, 28% were still fundraising at the time, so also could in the end fail. And only 27% did reach first close. And we know that there is a survivor bias, because that's the only funds that we've known about in the sample, but there could be plenty of people that actually never mentioned that did not reach first close. So we think the number is actually worse. It's very clear the SME investing space constraints are not met by all the LPs' expectations and demands and requirements as we speak. And we will maybe talk about DFIs afterwards, but basically a lot of the fund managers that we've seen, they don't have traditional background and track records when LPs tend to ask for 10 years track records in finance with exits, for example, and then you don't have that, then you can't fundraise. They ask for closed-ended structure, 10 years, so 5 years investment, 5 years disinvestments. Those structures, we know for a fact, don't enable the funds to actually perform in Africa, and that's basically because the SME growth path is not at all the same than in very different developed economies. And finally, they usually ask for a lot of skin in the game. And when you are an emerging fund manager, I'm looking at my colleagues over there, they already put everything they have in this initiative that they are trying to raise. So all of these issues, plus the fact that you could be a solo GP, for example, and so on, make it impossible for you to fundraise. The two things that we've seen have changed a lot of the landscape in terms of fundraising. One is progressive fundraising. Okay. When we look at the same sample that I was talking about, basically 60% of the funds that did not reach first close had no progressive fundraising, when 50% of the ones that did reach first close had a progressive fundraising, which is start slow, build track record, then fundraise even more, and so on. And the second thing is sponsor funds. On the previous panel, my colleague David was actually explaining the IP Dev model, which is INP sponsor fund. The number is as striking. 60% of the funds that did not reach first close had no sponsor, when 50% had a sponsor did reach first close. So I guess those two things were I would say, the most innovative things in terms of fundraising. And then we can talk about structuring maybe later.
Yeah, thanks. I think that you've actually given us a lot to talk about, actually. Yeah. So you've mentioned progressive fundraising, and I would imagine, a part of that also includes finding an investor that can take the early punt on you to want to go in. And we've seen DFIs, try to put in a lot of catalytic capital towards that end. Jumai, it's a very good point here if you can sort of talk to us about how BII is sort of shaping, that environment instead of supporting first-time, fund managers. What form of vehicles do they look at, and where do they draw the line between something they find investable and what they think has some potential?
Okay, thank you very much. I mean, I think there's a lot to unpack with that question. For BII, for the longest time, we've been the largest fund of funds investor in Africa. So we've taken different approaches. We've invested in fund managers, but I do agree with Marianne that there is a lot of challenge that you need to unpack when you talk through what sort of fund managers are actually reached and what are some of the barriers to reaching some of the first-time fund managers. I think the solution to that is multiple folds. One way that we have approached this is for ourselves is really to take a step back in terms of just, if you take the SMEs, which are essentially the underlying customers that these funds are trying to reach, what are their biggest challenges? The fact that they lack scale, the fact that the perception of risk is high, they're in environments where they're prone to external shocks, they're unable to get long-term capital, and build a track record for people who would invest to trust in the businesses. So we've piloted something very recently, which I wanted to just highlight. We've essentially launched a platform called the Growth Investment Partners. We've done so in Ghana and we've done so in Zambia. And what it is essentially a combination of catalytic and growth capital, where we've said, look, we want to provide patient capital in these markets to invest in SMEs who are maybe unable to get funding from banks. The target, particularly here, is the sort of SMEs that are not able to tap funding from banks. So the idea is to give them long-term capital, but in a currency that is exactly the currency of the business and de-risks the business. So again, we are taking the local currency risk in this sort of structure. You know, with that, I think the other side of it is to also to prove that there is something credible here in funding these sort of SMEs through the structure, is to be able to mobilize institutional capital from the market. So we're very focused on not being the only investor in this form. We are very keen to see how we can pull local pension funds and ultimately get these sort of structures on the capital markets at some point. I think there are quite a number of examples that I can provide that are similar, but just to close with, the key thing is really just first understanding the scale of the problem and maybe attacking it in the most simplest form and building on that with different sort of elements to address other sides of the risk.
Okay. Thanks, Jemai. So you've mentioned local partnership through mobilizing pension funds. You've also mentioned some things relating to fund design that's helped you to sort of fund SME funds. Perhaps hearing from a GP perspective in there, could you tell us, you are actually working in the trenches of SME investing in Africa. So all the issues that are mentioned here, you live with them on a daily basis and find solutions on how you can progress. Can you tell us, you know, what exactly are the challenges you face in terms of fundraising and also deploying, you know, capital on the continent? And I like what you said earlier in terms of, you know, local pension fund participation. And she also mentioned, you know, trying to pull or mobilize capital from local investors as well. Are you finding, you know, some form of success in blending local and international capital, or what is needed to move the needle?
Yes, so the challenges are many, but I think, for example, for raising funding from, for example, local pension fund, one of the main issue is, at least in our region, most of the funding cannot go outside of a vehicle that's not incorporated within the region. Yeah. Meaning that if you create a fund in Mauritius, that local pension fund cannot put money into that fund. So you will have to create another special vehicle locally and then a side vehicle for you to be able to get that money. And that brings in a lot of other complexities and intricacies that makes the whole funding model very challenging, especially when you're raising a small fund. Layers. Yes, that brings layers, exactly. So that's one of the difficulties, but for example, we have also some sovereign wealth fund. Why I'm saying this is some of them are themselves raising funding outside of their countries from international investors and or countries. And with that money that is coming in from international investors, they get the money from outside, and some of that money has a mandate to be invested in funds like us. So that can, you know, mitigate some of the issue, but it's very, very targeted. So you really have to know, you know, that specific fund. You have to get all the boxes checked for them to be able to consider you. But at least it's one step forward that kind of solves that issue. But the real problem will come in when they have their own funding and they want to invest in a fund that's incorporated outside of the region. That is to be seen. We'll see what happens. For example, in our market, the capital market, the regulator it has not yet set the way for us to be a true financial hub where funds can be properly incorporated. And that brings also another layer of complexities and issues that we have to deal with, meaning that even if you have, for example, a DFI-backed funding mechanism, a foundation, for example, that wants to bring money into funds like us, and the vehicle is incorporated outside of the region, they don't want to put money into it. But when you create the vehicle within the country, then you have another issue of other investors not coming in because it's local. So anyway, it's really a tough environment to create fund and do it properly like others. And even though everybody will tell you that if you are first-time fund managers, DFIs won't put money into you, that's true. But at the same time, it's not true, because most of the programs that are funding funds like us are DFI backed. So one way or the other, you have to, they're there. Like, they might not be there directly, but they're like one layer or two layer there. So that's comforting for us, but it brings also a lot of attention on the same DFIs from funds all over Africa. So you're dealing with funds in Uganda that are looking at the same DFI. And how do you get yourself ahead of the game? That's another challenge. So it's challenging. It's not easy, but I think nothing is easy in life, I guess. And we have to just do our best in trying to fit the boxes. And some of the DFIs will tell you that don't go fancy on your first or second fund. Just do the standard vanilla thing. Go incorporate it in Mauritius. Bring in the money, do your thing, do your track record for the fund 1, fund 2, and then you can maybe try to be. And that even is not true, because I know people that are working in more established PE funds that have raised 500 million and above, and some of them told me that the third fund has been the most difficult fundraising they've had to date. So the equation is, I think at the end of the day, it doesn't matter. It's just a difficult game we are in. Yeah.
Thanks, Ndeye.
Just one quick
Yes, please.
comment here. I worked previously in private equity firms, and we faced the same problem while doing investments in Egypt and North Africa and different funds and the clusters of LPs and investors and DFIs and the locals with the government involvement and pension funds. So we did a kind of a parallel mechanism or SPVs, which are extremely sophisticated, and layers and layers and approvals. However, it's a parallel mechanism, one offshore for the foreign investors and the other local for the governmental institutes and the pension funds and all of this. But of course, it's a headache. and different, then you do same investments and everything, but it's different treatments in accounting, different treatments in taxes, different treatment in currency, a lot of problems.
Yeah, I mean, I have my own fair share of the experience as well with local pension funds and trying to get them to invest in some of the bonds that we've done. And while there is a lot of, at least in there from what I can hear from you, there's a lot of regulatory need to push, right? So you need a key man person at the regulatory level, sort of pushing them, to do certain things, because otherwise it's still business as usual for them. But I hear you in terms of trying to get a structure that works for both local and institutional foreign investors without having to incur a lot of transaction costs and operational inefficiencies. Juma, you did make a good point on local currency, right? And obviously with SMEs, local currency is really, if you're very frank about it, is the way to go. There's less risk on the business, at least in terms of credit risk is preserved. They don't have to worry about FX volatility at the end of the day. And with my work at the African Local Currency Bond Fund, we've seen that when you do a local currency play, it sort of helps, with investing on the continent. So my question to you is do you deploy local currency or foreign currency, or?
For what we've done so far, we were lucky enough to be able to deploy in local currency, but we know that that was a very exceptional case, and the funding that we're raising right now is not, it's USD denominated. So that will have nothing to do with the funding we had so far.
Okay, but so you get a lot of demand for local currency funding needs.
Yes.
But obviously there's a mismatch with what investors can provide and the level of risk they want to be able to, to expose themselves to. Do you sort of have any innovation within your fund structure that allows you to at least consider some local currency investments?
Like for example, if it's a local, for the side vehicle that we will have for the the local investors, it's going to be in local currency.
Right.
So that's not going to be an issue. The real issue is with the foreign investors. That there's not much you can do, unfortunately, but that's why we're having this strong push and lobbying, I guess, around having more local investors coming in, like the pension fund, the insurance companies. That is crucial for us. So the more weight they have, the more less issues we'll have with having to deal with foreign currency. But unfortunately today that's not the case, so that's just one more risk that we have to deal with, and until we are able to balance things out, to be able to at least say that we can raise 70% of the funding locally and 30% internationally, but today that's not the case. It's the contrary, actually.
Don't worry, Brightmore is not alone. You're in good company. And Marianne, so Indaya did touch on fund structuring a bit with the use of side vehicles and whatnot. Yeah. To what extent do you think that can actually be very useful for first-time fund managers to be able to raise some money, deploy to show some track record before then they go on to raise an actual fund?
I mean, the reason we did the report that we're talking about was truly to unlock more capital for emerging fund managers. So it was not just to say, let's debunk all these assumptions, which was interesting, by the way, but it was also what are the solutions for those first-time and emerging fund managers. I would say two things. One is, when we did the report, we realized that the data that was available on fund performance were not updated since 2019, so that was even like pre-COVID. And to this day, our report is the only one on the very same performance. And then the second thing is, in terms of structuring, when you look at the sample that we have, it's very interesting to see that gross SME funds have very traditional structuring, close-ended funds and so on, but more than 60% of emerging fund managers have different kinds of structuring. PCVs, I think we have not yet talked about, like the elephant in the room, but permanent capital vehicles were the one that performed the best in the sample. So that's really something that we are convinced that could work. Locally domiciled with local currency exposure for very small tickets is also the way to go when we look at the sample. Enables a lot of, let's say, flexibility with the fees versus flexibility with the currency coverage. And that was, I think, out of the 55 funds that we did really put a focus on, it was 40% of them that were lingering towards this organization. And then when you look at I would say, all the side investment expertise, the investment readiness, the TA, the grants, we have talked about catalytic capital, about blended. All those things are the very reason why SME funds are performing better than they were 10 years ago, for sure. That's really something that we've seen. And blended structures are, I think, what should be the future of small SME investing. Yeah.
Thank you. It's good to hear you talk about permanent capital vehicle.
Yeah.
So the ALCB fund is a permanent capital vehicle, and there's a reason why it is a permanent capital vehicle, because it just takes time in order to be able to, our focus is capital market development.
The growth
pattern
is just not the same.
Exactly. For that, in that regard, trying to do a 5-year, 10-year, fund, it just doesn't move the needle in terms of trying to mobilize capital at scale for local currency investment. So let's talk a little bit about exits. Right, exits and liquidity are things we hear about a lot with LP concerns and now GP ethics. I'm sure that keeps you awake at night in there.
Not yet, but I guess in a few years it will. But for us, exit will mean just mostly, even though we have the stock market, but we know that most exit won't happen there. Most exits will happen with another fund, a bigger, larger fund probably. So the thing is to be able to really have those conversations early on with those funds, and really know your ecosystem in terms of who would be interested potentially in buying you out when you want to get out. So that's, for us, that's the thing, having those conversations early on, just knowing them and them knowing you and following you and just, you know, being there. That's our strategy. The IPOs are there, but we know that the reality is most of them won't go IPO for as an exit strategy for us.
Okay. And what are you seeing? Perhaps this is an open question to the panel. What are you seeing in terms of models that are working to give liquidity back to LPs and to exit investments? We've heard a lot about partial exits. We've heard some revenue-based financing. I don't know to what extent you're seeing anything relating to continuation funds or, you know, secondary sales like there was alluded to. So.
Okay, let me take this from a little bit of a different general perspective for the capital markets. I think we are seeing a kind of enhanced appetite for a regional deal flow, which is now we can say that a lot of investors from the Gulf, as per the virtue of my nature of work, I'm working, doing a kind of bridging the gap between the Gulf investors and the African opportunities. That's one aspect of my business. So we can see that now there is a good appetite for that deal flow. It's a regional and international deal flow. New pockets are with a lot and massive funds are interested to invest in the African continent other than the old traditional investors and FDIs. And they are targeting, we can say, a kind of different opportunities like the infrastructure funds and logistics, renewable energy, green bonds, all of this. This is a very hot cake for them. And you can see as well from China a good flow and from the Asian continent. Having said that, we can say that we need a better maturity for the capital markets and the exchange, and we have seen this in 2022, the African exchange linkage project, which happened. However, it's not that there is no high traffic on it. However, it's there and it's a good initiation. And I think governments should support this and support the listing of some governmental entities and other private entities on such platforms. And these platforms are served perfectly by the Fintech and the digitization that we are seeing currently. It makes it easy for a new different investors, local and international, who are not sophisticated, who are not large in ticket. However, they are mass and they support the ecosystem. So this is quickly my views from the mergers and acquisitions side on the capital market side.
Thanks, Sharif. And if I can hear you correctly, this type of investors, they are looking for, you know, large ticket transactions in which to, you know, put their funding in, and something along the route of capital market or even some form of large syndicated debt deals is something that they might actually consider. right?
Yes, there is a good appetite for this, and we have seen this on a lot of transactions. And you heard the sovereign wealth funds for the Gulf, from Saudi Arabia and United Arab Emirates and all of the other, and Qatar have invested billions and billions in Egypt and North Africa in the last couple of years. You can say $60 billion. And they have a good appetite to penetrate the African side, all of it, sub-Saharan, east, west, and they are searching for a good growth opportunities for them, because they exhausted the European side and the American side on the real estate fronts and on all fronts. So there is a lot of opportunities.
Okay, that sounds like, okay, I hear the bell ring. Before we, round off on the panel, Juma, I want to hear from you, because we quickly touched on capital market there. What do you see? How is it evolving to allow more financial institutions, SMEs in particular, to come to the capital market? And what instruments, from your perspective, do you think are scalable enough to allow them to do this?
Yeah, thank you. I mean, capital markets, especially debt capital markets, is one that is exciting in Africa at the moment. We're seeing quite a lot of bond issuances, especially labeled bonds, green, social, sustainability type bonds come to market. And to your point, I think there are a few things that have been mentioned here that, we've been trying to bring into the sort of structures that we support. I think on one hand, you have impact investors who are looking for opportunities to actually scale SDG type, ESG type assets and financing on the continent. And this is where this sort of GSS, I don't know whether they've added one more S now, bonds come in play, because they're a very good way to bridge the sort of long-term impact fund capital with local capital needs. What we are trying to encourage is now move a bit away from the international capital raises, bilateral dollar facilities, dollar syndicated loans, where, interest rates have increased significantly. If you look at how SOFR has moved, we want to encourage more local currency issuances. And what excites me most about this is, NMB was in the room earlier, is we're doing this in a way that, you can issue a public local currency bond, where BI, for example, has come in, and yourself, as ALCB, you've come in as anchor investor, given that early commitment, de-risked, and removed the execution risk of big issuances on the continent. And then layering that with a sleeve of USD private placement tranche, which then brings this sort of interested parties that Sheriff was talking about into this sort of instruments without having necessarily to take the local currency risk that maybe DFI is a better position to take. So we're seeing a lot of these bonds, and there's a lot of visibility that is building around there. And you talked about exit earlier. I think, again, back to this NMB bond, the interesting thing was how they then dual listed on the London Stock Exchange, particularly the private placement tranche, which then allowed for these international investors to have an exit route. I think that's an interesting one I'm seeing, just this sort of bonds. Another one I think worth talking about is the pooled bond structures, because sometimes we talk about scale and the fact that African FIs and businesses and corporates are sometimes too small for this sort of investors to come into. So we've done, pooled bond structures, one out of the continent in India, for example, where we pooled 5-6 MFIs into one private placement structure with a guarantee on it. And what that did in the midst of COVID, where liquidity, of course, dried up first for the MFIs and SMEs, it was that it allowed these sort of entities to continue to raise funding and to continue their business and thrive in this sort of environment, and ensure that they can do that in a way that they're able to come together 5 at once. Then you have a sizable ticket to attract international investors as well.
Thanks very much, Juma. I don't want to hear that bell any more than I need to. So very quickly, can you all just tell me, short and sharp, what do you sort of see as the earth-shattering innovation, right, for African capital markets, say by 2050? It doesn't need to be, something financial. It could be a mindset, right, or it could be a policy shift that you feel like by 2050, this is definitely the game changer for capital markets investing in Africa, or bilateral. Please go.
I'm going to go with the policy making innovation, I guess. When we looked at Ghana, at Nigeria, for example, during the study, we saw how those markets completely shifted thanks to policy making that were basically VCTF in Ghana and all those institutions. I think international investments ebb and flow. They probably, USAID was just cut, political climate in the Netherlands, in the UK, France, and so on, makes it very hard to believe that this money will still come to Africa in the upcoming years. So I really think that unlocking local capital, thanks to those policy reforms, is what should be existing in 10 years. And yeah.
Thank you.
I think for me, once the policies are in place, and then you have businesses, of course, ample opportunities. I think what I would like to see, the ambition also for BI, is diversification of the investor pool and mobilization at scale. For us, we want a world where for every $1 of our money, there's at least $5 of others coming behind us.
Sure.
I echo what my colleagues said, and I think that digitization is extremely important for the whole ecosystem and facilitating the flow of funds in and out the system.
Next,
I would like to see more local resource mobilizations from the diaspora, from local subsidiaries of multinationals, large corporates, and the usual, just bringing in more money into this space, which is not happening, or it's happening too little. I think that would be the game changer once we get to that.
Thank you to all of you. I think we've heard it all. A lot of innovation, going on the continent in terms of capital mobilization, from designs or innovations in infrastructuring to capital market diversity, to also fintech coming up, and also variety in trying to bring in local pension funds into the fund structure. So I would like to thank our panel for their wonderful conversations this afternoon, and I hope you also had a good time discussing with us. Thanks, everyone.
Thank you for that.
Thank you.